In the US, commercial banks are required to hold a minimum reserve, a percentage of their deposit liabilities, in a non-interest-bearing account at the Federal Reserve. This reserve requirement gives the Fed a tool to influence how much credit the banking system creates. Higher reserve requirement? Banks lend less. Lower? Banks lend more. Here's a real-world example. In March 2020, as COVID-19 triggered an economic shock, the Fed did something dramatic. It reduced the reserve requirement percentage to 0 overnight. This was designed to ensure banks had maximum flexibility to keep credit flowing through the system. Before that, the requirement had been 0%, 3%, or 10% depending on the size of the institution. This is why ALM, asset liability management, exists. A typical bank holds long-duration assets, 20-year mortgage loans, funded by short-duration liabilities, 90-day deposits. That mismatch creates continuous interest rate risk, and Treasury's role is to manage that gap every single day. We're at the halfway point. You've covered interbank trust, the LIBOR collapse, the full repo structure, and how the Fed manages system liquidity. The next video in this series goes deep into how the Fed actually deploys monetary policy through these instruments in real time. Subscribe so you don't miss it. And Loop 3, Risk Frame 5, will arrive in a few minutes. Just 5 minutes left. Let's clarify it together. At the end of any given day, member banks of the Federal Reserve will find they have either too many reserves or too few. Banks with excess lend to those with shortfalls in the Fed funds market. These are bilateral, unsecured, predominantly overnight transactions with minimal documentation. The Fed funds rate is the interest rate on these loans, and it's one of the most important short-term rates in global finance. If a bank can't borrow enough in the Fed funds market, it has one last resort: the Fed's discount window. This is the Fed's lender of last resort facility. Banks can repo government securities to the Fed in exchange for cash. The rate is often called the Lombard rate, and importantly, this is not the same as the Fed funds market. Fed funds is interbank. The discount window is always between a commercial bank and the central bank itself. The question I always hear: if the Fed's discount window is already standing by to lend, why do banks still need the Fed funds market? Why not just go straight to the Fed? One word: stigma. Going to the discount window signals to the entire market that you can't find funding anywhere else. That's why throughout history, the discount window has almost always been used only as an absolute last resort. A Treasury bill, or T-bill, is a negotiable, zero-coupon, government-issued debt security with a maturity of less than 1 year. Notice, zero-coupon. T-bills don't pay interest in the traditional sense. Instead, they're issued at a discount to face value. You buy a T-bill for less than $100, and at maturity, the government pays you $100. The difference is your return. One critically important detail most people skip: T-bills are quoted on a discount rate, not a yield. And those two numbers are not the same. In the US, T-bills are sold via weekly auctions with maturities of 4, 8, 13, 26, and 52 weeks. The government also issues cash management bills on an ad hoc basis when it needs short-term funding quickly. From a pricing perspective, T-bills are quoted on an annualized rate of discount from face value, not in yield terms. This distinction matters. The discount rate and the equivalent yield are different numbers. Concrete example: a 26-week T-bill at a 5% discount rate does not give you a 5% yield. The yield is higher because you're investing less than face value but receiving exactly face value at maturity. Here is the most counterintuitive fact about T-bills. In extreme crises, when investors are panicking and need safety at any cost, T-bill prices can rise above face value. Yields go negative. You pay more than $100 to receive exactly $100 at maturity, and people still buy because the safety of U.S. government backing is worth more than a positive return. T-bills serve 3 critical functions in money markets. First, they help governments meet short-term funding needs. Second, they give the central bank a tool to influence liquidity and interest rates. Third, and this is important, they act as the pricing benchmark for all other money market instruments. The yield on a 13-week T-bill is your risk-free rate baseline. Everything else, CDs, commercial paper, repos, is priced at a spread above that. If you're studying for the CFA, the ACI dealing certificate, or any Treasury certification, discount rate versus equivalent yield is a classic exam question that appears repeatedly. Now, you don't just know the formula, you know why the two numbers differ, and you know when negative yields occur in practice. That's the difference between passing and failing an application question. Look at this comparison, because these three instruments are frequently confused with each other. All three are short-term funding. But CDs are backed by deposit insurance, CP is entirely unsecured, ABCP is backed by underlying assets. Cost rises with risk. CDs cheapest, CP higher, ABCP highest, but with collateral backing. A certificate of deposit, CD, is a receipt issued by a bank to confirm that money has been deposited, issued at par. The bank commits to repay principal plus fixed interest at maturity. Here's the key feature. Unlike a simple bank deposit, a CD is a negotiable instrument. You can sell it in the secondary market before it matures, which means you don't have to wait for maturity to get your money back. A CD and a plain time deposit are economically almost identical. Same bank deposit, same fixed rate. So why does negotiability make such a meaningful difference for institutional investors? Because negotiability equals liquidity. If you need cash urgently, you sell the CD on the secondary market. With a standard time deposit, you break the contract and pay the penalty. The liquidity premium, that's what you're paying extra for when you buy a CD instead of placing a time deposit. How do you price a CD midlife? A CD with an original 90-day term but only 60 days remaining will be worth the present value of its final cash flows, principal plus interest, discounted at the current market rate for 60-day CDs of equivalent credit quality. Higher current rates mean lower present value. Lower rates mean higher present value. The same duration pricing logic you'd apply to a bond, but with a very short time horizon. Commercial paper, CP, is short-term unsecured debt issued by banks, finance companies, and non-financial corporations. Financial institutions are the dominant issuers. Because CP is unsecured, it carries more credit risk than a CD and more capital and liquidity cost for bank holders. CP programs are typically supported by dealer firms who market the paper to investors and try to maintain a secondary market. Here is what happened to the commercial paper market in the 48 hours after Lehman collapsed in September 2008. Dozens of U.S. corporations, tech firms, airlines, auto manufacturers relied on CP every single week to make payroll and pay suppliers. When Lehman went down, the CP market froze completely within 24 hours. Not because those companies had any problems, but because no investor was willing to buy any form of short-term debt from anyone. That's why the Fed had to directly intervene in the CP market for the first time in its history. Asset-backed commercial paper, ABCP, is CP collateralized by other financial assets, typically receivables. A bank might want to sell its credit card receivables off its balance sheet. An auto manufacturer might want to fund its loan portfolio. Both can do this through an ABCP program. They sell their assets to a special purpose vehicle called a conduit, which is usually sponsored by a bank. The conduit issues ABCP to investors, typically money market funds, to fund those purchases. The conduit collects the cash flows from the underlying assets and passes them through to investors. ABCP adds a structural layer, but the logic is clean once you see the diagram. The asset originator wants to sell. Investors want safe short-term paper. The conduit sits in the middle, buys assets, issues paper. The sponsor bank guarantees the structure's integrity. Derivatives are used extensively in money markets, primarily to manage interest rate risk and to lock in forward funding costs. The largest single money market derivatives market in the U.S. is SOIF futures, exchange-traded contracts on the 3-month SOIF rate. Beyond futures, the OTC space includes forward rate agreements, or FRAs, contracts locking in an interest rate for a future period. Interest rate swaps, caps, floors, and swaptions. FX swaps deserve special attention. An FX swap is a transaction where two parties simultaneously lend each other equivalent amounts in two different currencies for a specified period, agreeing upfront to re-exchange at a set forward rate. On the surface, this looks like an FX product. But in practice, especially for banks outside the US, FX swaps have become one of the most important money market instruments in existence. Here's a number that clarifies the real nature of FX swaps as a money market instrument. Nearly 2/3 of all FX swap activity globally carries a maturity of 7 days or less. Not months, not weeks, 7 days or less. That is a money market, just dressed in foreign exchange clothing. Here's why. The US dollar is the world's reserve currency. Most cross-border trade and finance, regardless of where in the world it happens, is denominated in dollars. A bank in Tokyo, Frankfurt, or Singapore needs dollars every day, not because their economy runs in dollars, but because their clients do business globally. An FX swap allows that bank to effectively lend its home currency and borrow dollars for the period of the swap. Nearly 2/3 of FX swap activity involves maturities of 7 days or less. That tells you everything about the liquidity function these instruments serve. Here it is, Loop 3, the framework I promised in the very first minute. The 5-risk framework that separates average analysts from exceptional Treasury professionals. Here's the master table. Take a screenshot or pause to take notes. Risk 1, interest rate risk. When you fund a longer-term fixed-rate asset with shorter-term variable rate liabilities, a rise in rates increases your funding cost while your asset yield stays fixed. Example: buying a 12-month CD funded overnight. A parallel shift up in the yield curve creates both cash flow losses, higher funding cost, and mark-to-market losses, lower CD value. Script line: interest rate risk in money markets isn't just about what you hold, it's about the mismatch between when your assets reprice and when your liabilities reprice. Risk 2, credit risk. The risk that your counterparty fails to pay. Almost zero in T-bills and reverse repos. Present, but manageable in bank deposits, CDs, and CP. Script line: the only truly credit risk-free money market instrument is a T-bill backed by a sovereign that can print its own currency. Everything else carries some credit risk, including your bank's interbank deposits. For a concrete benchmark, in the 8 weeks between September and November 2008, the U.S. commercial paper market contracted by $1.4 trillion. Credit spread risk and liquidity risk combined simultaneously at a scale that no bank's risk model at the time had forecast. Risk 3, credit spread risk. You can lose money on a money market instrument even if the issuer never defaults, simply because the market's perception of their creditworthiness deteriorates. The secondary market value falls. Spread widens. Script line: credit spread risk is what happened to Lehman Brothers paper in September 2008. Not an immediate default, but the spread blew out so fast that paper became impossible to sell at any reasonable price. For a concrete benchmark, in the 8 weeks between September and November 2008, the U.S. commercial paper market contracted by $1.4 trillion. Credit spread risk and liquidity risk combined simultaneously at a scale that no bank's risk model at the time had forecast. Risk 4, counterparty risk, distinct from credit risk. This is the risk that a bank dealer or client fails to meet its settlement obligations. Even very short tenor transactions carry counterparty risk for their full duration. Post-2008, mandatory CCP clearing for most OTC derivatives has significantly reduced, though not eliminated, this risk. Script line: counterparty risk is why CCPs exist. They don't eliminate risk, they mutualize it. Risk 5, liquidity risk. The risk that you cannot buy or sell a given instrument of given size without adversely moving its price. This is the most critical risk for corporate treasurers and T-bill investors. Script line: the September 2019 repo spike, when overnight repo rates hit 10%, was a liquidity risk event, not a credit event. Nobody thought their counterparty was going to default. They just couldn't find enough cash at any reasonable price. That's the difference, and it's a difference that matters enormously in a crisis. And here is what the risk table doesn't show you. In a crisis, these 5 risks don't hit one at a time. They collapse together, amplifying each other in sequence. September-October 2008. Credit spread widens, market liquidity evaporates. Counterparty risk becomes unquantifiable. Funding costs spike. All interest rate risk assumptions embedded in balance sheets become invalid. All 5 risks in 14 days. Now here's how these risks interact, which is what most textbooks miss. In normal markets, credit risk and liquidity risk tend to be well separated. But in a crisis, they collapse together. Credit spreads widen, market liquidity evaporates, counterparty risk spikes, funding costs blow out, interest rate risk assumptions built into your book are suddenly wrong. This is the cascade. Understanding it is what separates reactive risk management from anticipatory risk management. When I opened this video, I said the money markets are the plumbing of global finance and that most people don't understand how the pipes connect. Now you do. You understand that money markets are wholesale, short-term, professional markets, that interbank lending is the heart, and that the benchmark for pricing that lending was fundamentally broken in 2008 and had to be rebuilt from scratch. You understand repos, how they work, how haircuts protect lenders, and how tri-party and CCP repos reduce risk. You understand T-bills as the risk-free benchmark, CDs and commercial paper as bank and corporate funding tools, FX swaps as the mechanism by which non-dollar banks access dollar liquidity, and you have a 5-risk framework to evaluate any money market instrument systematically. Whether you're a Treasury officer, a credit analyst, an investment banker, a finance student, or an entrepreneur trying to understand how the financial system that your business depends on actually works, this is the kind of depth that makes the difference. If this video gave you real value, the subscribe button is right here. It costs you nothing, and it means you'll get this level of content every week. One thing I didn't cover today: how central banks use repos and Fed funds operations in real time to implement monetary policy, and how you can read those actions as market signals. That's exactly what the next video covers. I'll see you in that one.